Hi everybody, Hyundai is one of the most iconic companies to enter the Indian markets, and it is so hard to believe that a South Korean brand which was once a difficult name to pronounce, today the same brand is about to launch the biggest IPO in the history of India.
Indian stock markets could soon see their biggest ever IPO.
South Korean automaker Hyundai is gearing up for a significant milestone, going public in India.
Hyundai's IPO poised to be one of the largest in recent times.
This could be the biggest IPO that has ever happened in India.
This would be India's largest IPO and the first by an automaker since Maruti Suzuki in 2003.
In 1996, when Hyundai entered the Indian market, Maruti was the most dominating player with a 60% market share. And amongst the middle class, Maruti was almost a monopoly in India. But even then, Hyundai came in with Santro, i10, i20 and Creta, and it put a dent in the Indian automobile sector to such an extent that today it is the second largest automaker in the country with a profit of 4,653 crores. And if you look at the profitability, Hyundai is way ahead of Maruti. In FY23, while Hyundai made a profit of 65,355 rupees per vehicle, Maruti made a profit of 40,939 rupees per vehicle. So after 28 years of getting a very strong hold of the Indian market, now Hyundai plans to raise 25,000 crores with its IPO. Sounds fantastic, right? But you know what, guys? There are some hidden risks that Hyundai faces which may ruin all the progress that they've made in India. And all of this is mentioned in this 436-page DRHP paper that Hyundai filed with SEBI. So we went through all this data so that you can sit back and consume the most important bits of this 400-page document as easily as watching a movie. So in this episode today, let's dive in to understand how did a South Korean company like Hyundai break into the Indian automobile market, leaving the Tatas and Mahindras behind. In spite of being a foreign company, how did Hyundai achieve such high profitability and outpace a mammoth like Maruti in India? And most importantly, after making such an amazing progress, what are the hidden risks that can topple the growth of Hyundai in India? Also guys, a quick disclaimer, I am not a SEBI registered investment advisor, and this video is not meant to give you investment advice, but to only educate you about the rise of Hyundai in India. But before we move on, I want to quickly introduce you to our education partners of today's episode, which is Scalar School of Business, and they are bringing in something absolutely revolutionary. If you're seeking business education, Scalar is offering a full-time on-campus 18-month PG program in management and technology. And this program is designed by the leaders who have built billion-dollar businesses like Uber, Myntra and McKinsey. And today, legacy college names are useless without competitive skill sets. This is the reason why, as a part of the Scalar School of Business curriculum, you will work on real-world projects sourced from real companies, and you will have to build your own business as a part of the curriculum, take it to the market, generate revenue, and also raise VC capital while studying on campus. And since Scalar has been in the education industry for 7 long years, they already have access to 1,200 plus company partners, which is something that no other B school in the country can offer right now. For their online programs, they've seen placement rates of 96% with a median CTC of 25 lakh rupees, which is verified by B2K Analytics, which is the same partner that verifies the reports for IIMs. And now, Scalar School of Business is handpicking only 75 students for their founding cohort, which starts in August 2024. They have scholarships up to 100% and applications are open right now. So if you want to become a brilliant business leader, apply for Scalar School of Business using the link in my description and in the comment section. And now, on with the episode. People, the first thing you need to understand about a company is their philosophy of success. In this case, you need to understand what exactly is the philosophy that turned Hyundai into what it is today in India. Because like we saw in the Boeing video, no matter how much profitability, EBITDA or earnings per share a company has, if it deviates from this core philosophy, all these numbers will go for a toss. So let's understand this core philosophy and then we'll move on to profitability, EBITDA and other numbers. Now the question over here is, what exactly is the secret recipe of Hyundai's success in India? This is a story that dates back to early 1990s India. Until this point, India only had a few car brands, and these brands were Hindustan Ambassador and Contessa, Premier Padmini, Standard Herald and 2000, Maruti 800, Omni and Gypsy, and a range of Mahindra Jeeps. But in 1991, our Finance Minister Dr. Manmohan Singh liberalized the Indian economy to invite foreign direct investment in India.
We have to harness all our latent resources for a second industrial revolution and a second agricultural revolution. Our economy, polity and society have to be made extraordinarily resilient and alert if we are to take full advantage of the opportunities and to minimize the risks associated with the increasing globalization of economic processes. We have to accept the need for restructuring and reform if we are to avoid an increasing marginalization of India in the evolving world economy.
This is how, after liberalization, foreign automobile companies rushed to India. And when they entered India, if you look at the approach that these foreign companies had, it was very specific. Most companies only wanted to cater to the rich and sell only premium cars in the Indian market. So India saw high-end cars like Lancer, Opel Astra and Ford EcoSport. And it does make sense, right? If you're going to enter a new country with a high-cost product like a car, it is obvious that you have to sell to the rich first, make money and then bring products for the bottom of the pyramid. But when it came to Hyundai, they simply took a step back and identified 4 important gaps in the market. Number 1, the Indian automobile market did not respect the customer at all. So the customers back then were put on waitlist for months, after sales service was absolutely terrible, and everything from customer satisfaction to customer feedback was completely taken for granted. Secondly, they found that the compact cars back then were not solving for the India specific problems. For example, for Indians who used to wear a turban, the height of the car was too small. Similarly, the coolant system was not capable enough of cooling down a car in 35 to 40 degrees Celsius atmosphere. And most importantly, the cars were often damaged due to poor road conditions and monsoon seasons. This is the second gap that they found in the market. And thirdly, they found that it wasn't just the middle class, even the wealthy people wanted to buy several compact vehicles per household for their convenience. So while the sale of mid-sized vehicles barely touched 30,000 units, Hyundai realized that the compact vehicle segment had the potential to touch 60 to 80,000 units in annual sales. So the 3 gaps were seller's market leading to unhappy customers, ill-suited designs for India, and an untapped customer base in the upper class. And this is why, ladies and gentlemen, Hyundai launched an iconic compact car for India which went by the name Hyundai Santro.
What's unique about the Santro? The most powerful Epsilon engine, computerized multi-point fuel injection. Santro actually drives longer per litre. For bheed bhaad maybe, driving easy.
Santro back then was a complete value for money for the Indian consumers because they focused on the smallest of the details that no other car companies noticed. For example, for Indians who wore turbans, the height of the vehicle was increased. If you remember, Santro back then was called as the tall boy model. And lastly, they improved their air conditioning system to such an extent that their air conditioners could cool down their cars even when the outside temperature was 35 to 40 degrees Celsius. This is how Hyundai meticulously designed a model specific for the Indian consumer. And you know what, guys? To take it to another level, while most companies were trying to manufacture outside of India, Hyundai committed to India to such an extent that they set up a large-scale manufacturing plant in India itself. And this insane move gave them 2 incredible superpowers to dominate the Indian market. Number 1 was low-cost production, and number 2 was the superpower of producing cars at scale for the next 30 years. So Santro was not just a high-quality car with features, it was also a cost-effective car. And cherry on the cake, they made sure that they had dealerships in not just Tier 1 cities, but also in Tier 2 and Tier 3 cities. And by the way, one of the most amazing things that Hyundai did to familiarize themselves with India was to hire Shah Rukh Khan as their brand ambassador. This is how, by adopting a localization strategy, by focusing on better services in Tier 2 and Tier 3 cities, by customizing a car specifically for the Indian requirement, and most importantly, by getting close to the customer with Shah Rukh Khan, Santro became a huge success in the Indian market. And did they stop here? Obviously not. Hyundai went on to find another gap in the market in the early 2000s. During this time, if you remember, the market either had small hatchbacks like Santro, Maruti Ritz or a Maruti Alto, and it had premium luxury cars like Honda City, Honda Civic or an Audi A6. So if you look at this market, there was a huge gap for a mid-range product. It's like saying today there are only Vivo range products and Apple range products. And this means what? There is a huge space for a OnePlus type product in the market, which is a mid-range or upper mid-range product. Just like this, during the early 2000s, the market was segregated between economy and premium cars so discreetly that the middle class people only had the option of small hatchbacks. So they had to settle for an Alto, and there were no other options available which could give them an upgrade. And this is where the aspirational middle class of India yearned for something better than Alto, but cheaper than the premium cars. And guess what? Here's where Hyundai saw an opportunity. In 2007, they launched i10 followed by i20 in 2008. So if you see, they launched both a mid-range and an upper mid-range product in the Indian market. And not so surprisingly, both these cars were a massive hit in the Indian market. Why? Because the customers got premium features at a reasonable price. They got i10 for 3.5 to 6 lakh rupees and they got i20 between 4.2 to 8 lakh rupees. On top of that, these cars had multiple variants, fresh and vibrant colors, and most importantly, just like OnePlus phones back then, they looked premium but did not cost premium. So again, as we all know, both i10 and i20 became a massive hit in the Indian market. And then Hyundai did it for the third time in 2016. This time, they did it with Creta. So back then, if you studied the SUV market, you would have seen that only 10% of the cars sold at that time were SUVs, and this included Innova, Safari and Scorpio. But yet again, there were no mid-sized SUVs with a competitive price range of 8 to 9 lakh rupees along with premium features of power and efficiency. And while the customers perceived Duster to be too old and cheaply made, EcoSport was too small and Scorpio and Safari were considered to be basic. So again, Hyundai saw this as an opportunity and launched a mid-size SUV called Hyundai Creta in FY16. And when they launched Creta, Creta had everything from space to premium interiors to a long list of features without being as expensive as premium cars. So again, it was a big hit in the Indian market. In fact, in February 2024, Creta achieved the milestone of 10 lakh sales in the domestic market. And today, Hyundai is the biggest mid-size SUV seller in India with a 30% market share. This is the third leap that Hyundai took in the Indian market, and now they're taking the fourth leap with Hyundai Kona. So do you realize what is the philosophy of Hyundai? They are never the first moves in the market, but they study the market so well that when they bring out a product, it is always a value for money product which eventually capitalizes on the existing gaps in the market to such an extent that it gives them a huge edge in the market. Santro did this to Maruti, i10 did this to Alto, and Creta did this for Duster, Scorpio, Safari and Innova. And lastly, Hyundai provided its customers with an incredible after-sales service in Tier 1, 2 and 3 cities without ignoring any of them. If this is very clear to you, you have understood the philosophy of growth that Hyundai has followed from 1996 to 2024. So at any given point in time, if the company deviates from this philosophy, you will be able to sense it as an investor. If this is clear, now let's move to the numbers. Let's start with their profitability. If you look at EBITDA margins, Hyundai is very close to Maruti. Hyundai's EBITDA margins for 9 months ending on December 23, it stood at 12.7%, whereas Maruti stood at 13% and Tata Motors stood at 6.1%. But the question over here is, how did Hyundai reach such high profitability? Well, the first reason is their premiumization strategy. Long story short, while Maruti sells low margin, high volume products like hatchbacks, Hyundai sells high cost, high margin, high volume products like SUVs. If you see this chart, while Hyundai India gets 66% of its domestic volume from SUV body style vehicles, Maruti gets 70.5% of its volumes only from hatchbacks. Secondly, Hyundai has the superpower of something called free cash flow. Now, what is free cash flow? Free cash flow is basically the money that is left with the company after paying all its expenses and taxes. And here's where some people might get confused between profit after tax and free cash flow. But this is a very important concept. So if you don't understand the difference between free cash flow and PAT, here's a very simple explanation of the same. If you know it, please skip to this timestamp. So let's take the example of a bakery. Let's say this bakery generates a revenue of 5 lakh rupees, and in this bakery, just like any other company, there are multiple categories of expenses. Firstly, we have operating expense of 3 lakh rupees, which includes salaries, rent and raw material cost. Then we have an interest expense of 20,000 rupees. This is the money that the bakery has to pay as EMI for the loan that it took to buy a fridge. Then we have a capital expenditure of 40,000 rupees. This is the money that was spent on those things which will help the bakery generate more cash in the future. So they are assets like mixers and industrial ovens. And lastly, there is tax to be paid, which comes out to be 50,000 rupees. Now mind you guys, for the simplicity of calculation, we are not considering depreciation and amortization, and we are assuming that the working capital does not increase each year. Otherwise, this calculation will become too complex. So coming back to the calculation, after doing all this math, here's how the profit after tax is calculated. Operating income equals total revenue, which is 5 lakh rupees, minus operating expenses, which is 3 lakh rupees. Eventually, this number comes to 5 minus 3 lakh rupees, which is 2 lakh rupees. Then we have an interest expense of 20,000 rupees. So if you want to calculate profit before tax, it is 2 lakhs minus 20,000 rupees equal to 1.8 lakh rupees. And then if you remove taxes from profit before tax, you will get profit after tax. So from 1.8 lakh rupees, when you remove 50,000 rupees, you will get 1.3 lakh rupees as profit after tax. If this is very clear to you, let's move to free cash flow. People, free cash flow or FCF is the cash generated by the bakery after paying all its expenses and after spending money on necessary capital investments. So out of this 1.3 lakhs that it generates, we need to subtract this 40,000 rupees in capital expenditure. If you remember, back then we did not subtract 40,000 rupees of capital expenditure from our revenue. So now after you get your profit after tax and then you remove your capital expenditure, the free cash flow left with the company is 1.3 lakh rupees minus 40,000 rupees equal to 90,000 rupees. So this 90,000 rupees will remain untouched regardless of your expenses and your taxes. So long story short, free cash flow is the amount that is left with the company which practically remains untouched by taxes, capex or expenses. Now in the context of an automobile company like Hyundai, free cash flow is very important for 3 reasons. Number 1, it tells us how much money a company is left with after it makes its investment into machines and factories. So if a company generates 100 crores in PAT but has to invest 99 crores into building a plant, then practically the company is walking on the border of a cash trap with just 1 crore piece, right? Because automobile business is a cash intensive business. So even though an automobile company generates a lot of profits, it is very important to know how much free cash flow they have. So free cash flow for an automobile company tells us how safe a company is after making their heavy investments. So if the company has a lot of free cash flow, it means that in the future, this company will have the capacity to invest very heavily on futuristic infrastructure. This is the second reason why FCF is very important. For example, even with the PAT of 1000 crores, if an automobile company is only left with 10 crores in free cash flow, then it says that they may not be able to invest in heavy EV infrastructure in the future. Or it could also say that they are currently investing in heavy EV infrastructure. At the same time, if a company has 500 crores in profits with 400 crores in free cash flow, it says that the company has the superpower to invest in futuristic infrastructure. This is the reason why free cash flow is considered to be a superpower. And lastly, free cash flow tells us how much money could a company distribute in dividends and share buyback, because this is the money that they can give back to the shareholders. If you remember, this is the untouched money. If this is very clear to you, let's see how much free cash flow Hyundai has in comparison to Maruti. And here's why, ladies and gentlemen, you would be shocked to know that while Maruti's FCF stood at 10.4% of their profit after tax, Hyundai's FCF stood at a staggering 93.6% of their profit after tax. So it is absolutely brilliant. And this brings us to the third superpower, which is even more powerful and even more mind-blowing. This is something called negative working cycle. Now, for all the non-commerce students, this might be a little complicated, but don't worry. We'll understand this using a simple example. Let's say Think Motors starts the production of a batch of cars which will cost 1 lakh rupees each to manufacture. So to manufacture this batch, Think Motors will source all of its raw materials from its suppliers on a 50-day credit. Which means what? Think Motors would pay their suppliers 50 days after buying the materials. So after buying the raw materials, it takes Think Motors 40 days to manufacture this batch of cars, inspect them for quality, and then to transport them to dealerships. And during these 40 days, the cars are considered to be a part of Think Motors inventory. And this time is called inventory days, as in the number of days it takes for the company to sell its inventory. If this is clear, let's move ahead. Now, after the dealer gets the cars from the company, the dealer will sell these cars to the customer, receive cash from the customer, and then the dealer will pay Think Motors. Now, let's say the dealer has a credit period of 30 days, and during these 30 days, he sells these 100 cars and pays the company. During these 30 days, the revenue from the sale is recorded as receivables, and this 30-day time period is called receivable days. So if you see this entire process, it takes about 70 days for the car to get manufactured and then to be sold. But the catch over here is that during this 70-day time period, on the 50th day, Think Motors will have to pay its suppliers for the raw materials that they provided. Why? Because they made an agreement with the suppliers that they will pay these suppliers 50 days after purchase. And these 50 days are called payable days, as in the number of days a company takes to pay its suppliers. In this case, Think Motors has negotiated terms with its suppliers to pay them after 50 days of receiving the raw materials. And now let us calculate the working capital cycle, and then I'll tell you what it exactly means. Okay, so let's do the math first. Working capital cycle is inventory days plus receivable days minus payable days, which is 40 days plus 30 days minus 50 days. So the number comes out to be 20 days. So this means Think Motors will have to make the payment to its suppliers 20 days before they get their money. Which means what? They will have to lock in their capital for 20 days. And when it comes to automobiles, this 20-day lock-in capital could run into hundreds of crores. This is how companies like Maruti operate, whereby they have to keep their 22 days capital locked in into the working capital cycle. But you know what, guys? When it comes to Hyundai, they are so magical that they receive their money 26 days before they pay their suppliers. So if I were to explain this with hypothetical numbers, their equation would look something like this. They buy raw materials from suppliers on a 96.5 day credit cycle, manufacture and supply inventory to the dealer in 40 days, and the dealer sells the cars and pays Hyundai in just 30 days. So in 70 days, the product is sold and the money comes back to Hyundai. But the catch over here is that they would still have 26.5 days to pay for the inventory. So do you realize how magical this is? While other companies like Maruti have to lock in their capital for 22.5 days to pay their suppliers, Hyundai does not need to use its capital at all. It can simply use the money that it is getting from the customers and pay its suppliers. In fact, it has free money for 26.5 days, which it can then use for further investment. And you know what, guys? Apple is one of the few companies to have achieved this with their iPhones. So if you calculate their working capital from this equation, it turns out to be 40 days plus 30 days minus 96.5 days, which comes out to be minus 26.5 days. And this minus 26.5 days is an indication to state that Hyundai has the money from its customer 26.5 days in advance before paying it to their suppliers. This is the reason why if you look at their third parameter, which is return on capital employed, it is absolutely crazy. While Hyundai has a return on capital employed of 140 to 150%, Maruti stands at just 19.72%, which means for every 100 rupee that Hyundai invests in its business, it earns a return of 140 to 150 rupees. Whereas for every 100 rupee that Maruti Suzuki invests, it earns a return of 19.72 rupees. So if you see, Maruti Suzuki is less efficient in using its capital to generate profits as compared to Hyundai. So all of this looks fantastic, right? Then the question is, why did I say that Hyundai also has some hidden challenges and risks that you should be aware of? Well, that is because, ladies and gentlemen, there are three things that you need to look at and be concerned about. Firstly, Hyundai has two plants in Chennai and both of them are operating at 103% and 92% utilization. So, it will be very difficult for Hyundai to cater to the rising demand of cars and increase its market share. So, because of less capacity, they are producing less vehicles, which is increasing the wait time for its buyers. In fact, the waiting period for Hyundai cars can go from 6 weeks all the way up to 24 weeks. Now you might say, bro, that is why they are raising money through IPO, na? So the IPO will solve all these problems, right? Wrong, because here's where the second pointer comes in, which is the purpose of the IPO. People, this IPO is an offer for sale IPO, meaning the entire IPO money is going to the promoters of the parent company. So in simple words, it means that the money raised from the IPO is actually going out of the country to the promoters sitting in South Korea and not for the growth of the local business in India. And last and most importantly, while it is true that their profits are high, a large chunk of their profits are going back to the parent company in Korea. And they are not being used to grow the business locally in India. If you look at this chart, Hyundai's parent company Hyundai Motor Corp, they were earning a royalty of 2.5% of the total revenue of Hyundai from India. But just a week before the IPO, this royalty was increased from 2.5% to 3.5%. Now mind you, this is not 3.5% of the profit, it is 3.5% of the revenue. And considering the fact that the PAT of the company is 7.66%, a 3.5% royalty from the revenue is a very, very big deal. Now, this is not to say that the parent company has no right to take in royalties from the daughter company. It's just that, from the investor standpoint, when the company's plants are functioning at full capacity, it is important that the company allocates a large chunk of money for capex investment in India. So, if the same trend continues, whereby the company is just giving out cash, this superpower that Hyundai India has acquired over the past 28 years, that may not be put to best use to dominate the Indian market. And that for the investor may not be the best thing in the next 10 years. But at the same time, if the company invests enough in India and then takes back the rest to South Korea, there is no issue for Hyundai in India at all. This was the story of rise, strength and weakness of Hyundai India in 2024. And I just hope you learned something valuable from this case study. That's all from my side for today, guys. If you learned something valuable, please make sure to hit the like button in order to make YouTube happy. And for more such insightful business and political case studies, please subscribe to our channel. Thank you so much for watching. I will see you in the next one. Bye bye.